Good morning, everyone. It's Monday, August 21st, and I hope you're going to have a great day trading. It's a beautiful day here in New York weather-wise. Let's start out looking at the economic calendar, and today there are no announcements scheduled, so let's move on then to the morning news. Now, in the morning news, the first thing I look at, and I always check the CNBC website, doesn't matter what website you choose to use for the news, because the news that you're going to read in the morning pre-market, and this is about a half an hour before the market is set to open, the news is basically going to tell you absolutely nothing about the most important thing that you want to know, which is, where is the market likely to trade today? Okay, so here's one hint. Today is Monday. Now, if you don't know what that means, Monday is the most likely day for markets to rise, for the market to rise. And I'm talking about the S&P market. I trade S&P E-minis. But Monday is the most likely day for the market to rise. I don't know, I guess it's because traders might have had a great weekend and they're looking to be happy on Monday and extend their Gemütlichkeit. So today, looking at the flags, everything is in the green. Dow is up 64. It was up over 100. S&P futures up 15. Basically, everything's looking good, right? Except one thing here, U.S. 10-year note, 4.308. And I'm going to go into the effect of interest rates on the market in another video, but let's just leave that alone right now. Scrolling down the page, there are some interesting headlines, basically, that I take as being entertainment. And so if I have some time to kill, I might click on one of these headlines and read the details. But basically, the morning news is going to tell you nothing as far as the most important thing, which is, of course, where is the market likely to go? So then let's move over to the charts. Now, this is my chart of Friday, August 18th. And in looking at, in hindsight, at the market on Friday, and I always calculate where the market is likely to trade using formulas originally developed by George Taylor. Many of you know about the Taylor trading technique. Most of you probably have heard of it, but don't know what it is, how to use it, or what the basis of its value is. So let me just tell you, the Taylor calculations are going to tell you, or tell me, where the market is likely to trade on any given day. And so and without going into the science or the arithmetic behind it, I'm just going to say that on Friday, the market didn't trade in a range as great as what the calculation was. The calculation was about 54 points, 53 points. The market traded in a 46-point range, less than what was than what was expected. But nevertheless, as you can see, the market opened down here at 43.53. And if you knew nothing else and you had the ability to calculate where the market was likely to trade, you could get on in this trade. And there's two motivations for getting on or making a trade to the long side at the open on Friday. First of all, it was a Friday. If Monday is the most likely day for the markets to rise, Friday is the second most likely day. So again, if you opened up your chart on 9:30 on Friday and traded to the long side and then closed your computer for the rest of the day and came back just before the market closed, you would have done very well. Well, how well would you have done? Well, looking at the range again was calculated to be around 52 points. And of course, the previous day's close, and you always mark the previous day's close on your chart, don't you? And if you don't, you should. And if you don't know why, please contact me at timelessdollar.com. So looking at the range for the day, and I'm going to show you, I'm going to clone the range, and I'm going to move it down to the intraday low, where the intraday low is put in. And that forecast that the market was going to trade at 44.02 and a few ticks. Market actually traded up to 43.96, 6 points less than the forecast, but still not too bad. If you got on the market right over here, you would have made over 40 points. So, okay, that's one way to look at the market. Again, it's knowing where the market is likely to trade. And so I use these indications to tell me where the market is likely to trade. That plus the stochastic that I use to basically give me some confirmation of where I should enter or whether I should enter and in what direction. And I also look at how prices are moving, not the absolute candles, but how long are they? How short are they? Are they moving quickly? Are they moving slowly? Reading the prices is basically, if you are looking at price action, what are you looking at? You've got to know price action. Price action is prices going up and down, right? But you've got to know what the price action, what to look for when you look at price action, and I've just told you. And so I'm going to give you a little more insight into where the market is likely to trade on any given day. And the market, the absolute calculation was 43.63 in support and 44.15, 44.16 at resistance, and the range between them. Now, of course, there's a range between any two numbers, right? But let me tell you this, and I don't think you're going to appreciate this. Those of you who know about the Taylor calculator, you will appreciate this. The range is absolutely independent of the absolute top and bottom prices. The range is independent. It exists independently. The market is going to trade. If I said to you the market is going to trade in a 50-point range today, starting from where? And if you know where it's going to start, and I tell you the market's going to trade in a 50-point range, and you know it's going to start, well, you can say, well, is it going to be 50 points higher than the start or 50 points lower than the start? You see what I mean? At any rate, knowing this information makes you a better trader because it gives you more information of where the market is likely to trade. And so here on Friday, the market closed right here on Friday at, let's see, it closed at 43.85, around there, 43.85. Okay, and the market was trading at around there at 2 in the morning, 3. This is 3 in the morning. And the market was trading there at 3 in the morning, and now it's about 9 o'clock, a little after 9, and the market has risen up. And so from 3 in the morning to, at 8 o'clock, it went up to 44.07, much higher than the 44.85 of 43.85 that where it closed. Why did it go up? Well, that's for you to know, okay, or to guess. To me, I just note the market went up over where it closed. So that's as much as I can tell you. So again, the most important thing that you need to know as a trader, if you're going to be consistently successful, is how to trade. And knowing how to trade comes down to learning the basics and learning what to look for when you look at price action, knowing how to mark your chart, how to measure using the Taylor the Taylor calculator. If you know about it, if you don't, check out my site at timelessdollar.com. You can get it there. You'd be a better trader. At any rate, thanks so much for watching. I'm sorry to be wordy. This is Marv Eisen from Timeless Dollar Trading Academy. Trade safely, use lots of patience, and I'll see you in my next video.